So welcome everyone. Sorry. This is the first topic where we are going to learn the applicability of Ind AS, difference between Ind AS and IFRS in general, why Ind AS was introduced in India, what are the benefits of Ind AS, etc. So first we will look at the global scenario. World over, which are the two most important standards? World over, which are the two most important standards? One is IFRS and the other one is US GAAP. So we will see the development of IFRS globally, how IFRS came into picture and why more and more countries are now adopting to IFRS. So the journey started from 1970. The journey started from 1970. In 1970, Eurozone was formed. That means group of European countries. They came together. They are called Eurozone. Now you know the special feature of Europe. It is consisting of small size countries. Countries like say Germany, France, Italy, Austria, their population is less than even in some cases a city of India like Kolkata or Bombay or Delhi. So they came together for better coordination and therefore Eurozone was formed. This was the after effect of the World War II. Then International Accounting Standard Committee was formed. What was the earlier version of IFRS? The earlier version of IFRS was known as International Accounting Standard, and now they are called IFRS. So the committee which was formed for issuing International Accounting Standard was IASC, International Accounting Standard Committee, was formed for common standard across Eurozone. So all the countries in Eurozone will follow the same standard. These standards were recommendatory. That means it was not mandatory on the members of Eurozone. So again the problem was that different countries may follow different policies as the standards were only recommendatory in nature. Which were the standards issued by this IASC, International Accounting Standard Committee? The standard issued were numbered as IAS 1, IAS 2 up to IAS 41. What happened after that? After that, International Accounting Standard Committee was replaced by another body. Okay. Then there was one more committee formed which was called SIC, International Standing Interpretation Committee, which was called SIC. On IAS was formed. What was the purpose of SIC? The purpose of SIC was to provide interpretation of standards. Interpretation of standard means if there was some doubt, some explanation, some ambiguity, that will be clarified by the SIC. So this was the earlier version of IFRS, where a committee IASC was formed, Standing Interpretation Committee was formed for interpretation of the standard. Now comes the next phase. Next phase is 1983. Cross-border financial scams were increasing. So as you know, the number of financial scams were increasing. Hence, there was a need for a capital market regulator association because financial statements were not comparable. People were not able to understand. So now the time has come to make a capital market regulator association, and need will give rise to innovations. An international body was formed. It was called IOSCO, International Organization for Securities Commission. And good news, SEBI is also a member of IOSCO. So all the international capital market regulators are members of this body, and today almost 90% of the world capital market regulators are members of IOSCO. So if you want to know more about it, you can do the Google search and you can learn about it, but right now not required, not for exam purpose also, but the topic is in general understanding of Ind AS. So we are going through the background, first how the IFRS got created, and then from IFRS Ind AS was created. So IUSCO asked its members, IESC, for making standards mandatory. Earlier it was recommendatory, now it is mandatory, and therefore IESC started its efforts to make IAS mandatory. So that was 1983, and then they started their efforts to make the standards mandatory globally. Then came 2000. IESC was reconstituted, and now it is made International Accounting Standard Board. So everywhere now you will find it is written IASB, International Accounting Standard Board. Which form of standard do they issue, US GAAP or IFRS? They are responsible for issuing which standard, US GAAP or IFRS? IFRS. IASB started issuing IFRS. So now all the new standards which are being issued, they are given a prefix as IFRS. Earlier it was called IAS. Earlier it was called IAS, which was issued by the first body, International Accounting Standard Interpretation. The earlier body was called IASC, International Accounting Standard Committee. This was issued by IASC. Now IFRS are issued by IASB, International Accounting Standard Board. So what is the numbering system now they use? Have they continued after IAS 41, or they started with a new series? They started with a new series. So these old will be reviewed. Slowly and slowly you will find many of the old IAS has been removed, and in place of that new standards are issued. Like earlier there was standard on leasing under IAS. Now that has been replaced by IFRS 16 on leasing. There was standards on revenue, that was cancelled. New standard on revenue was issued. There were standards on financial instrument, they were cancelled, replaced by new standard on financial instrument. So old standards will be reviewed or amended as per the needs, and if required they might even delete the old standard, and in place of it they will come out with a brand new standard. So IFRS is the new version of IAS. So IAS plus IFRS is equal to IFRS. What an equation. So IAS is also a part of IFRS. So when I say IFRS, it means IAS 1 is also applicable up to 41, and plus the new numbering series. IFRS is now world's most recognized global accounting standard. Most recognized. Sir, why? 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 More than 130 to 140 countries have now either adopted IFRS or have converged to IFRS. Whereas US GAAP, which is another popular global standard, is mostly followed in USA. But rest of the world, they follow IFRS or something close to IFRS. Like in India also, we follow Ind AS. This Ind AS is close to IFRS. Till date, there are 25 international accounting standard, IAS 1 to IAS 41. Why the number is different? Some of the IAS have been deleted. That is why numbering system will say 1 to 41. But if you actually do the counting which are applicable, only 25. So approximately 16 standards have been deleted, and in place of that new standards have been issued. And what about IFRS? There are 17 IFRS. There are 17 IFRS, IFRS 1 to IFRS 17, and both are referred to as IFRS only. So the interesting part is that IAS plus IFRS is known as IFRS. So we don't say International Accounting Standard anymore, we just call it IFRS. So what is the composition of IFRS in totality? As we have learned, up to 2001, up to 2000, April 2001, the standards were issued by IASC, and those were given a prefix of IAS. Then from April 2001 onwards, the standards have been issued by IASB, and they are called IFRS. In order to provide interpretations for IAS, the body was known as Standing Interpretation Committee. And do you know what is the name of the body which provides interpretation of IFRS? That is called IFRIC. That is called IFRIC. That is Interpretation by International Financial Reporting Interpretation Committee on IFRS. So we will in short call it IFRIC. It's a big name. International Financial Reporting Interpretation Committee on IFRS. Right, everybody, any doubt? Now we'll come to Indian scenario. That was like a background for IFRS. Now we are more interested in Indian scenario. What is the significance of 1981 in the Indian accounting standard history? In 1981, ICI had formed Accounting Standard Board, ASB. Okay, ASB. And it was motivated by International Accounting Standard Committee. So at global level, IASC was formed around this time. In India, the Institute of Chartered Accountant of India also formed ASB. And then what was the main role of ASB? The main role of ASB was to issue accounting standards. How many standards they have issued? How many accounting standards they have issued? They have issued AS1 to AS29, it's written there. Earlier there were 3 more standards, AS30, AS31, AS32, but these 3 standards were deleted. Okay, so you have studied in your intermediate batch up to AS29, and also AS8 has been deleted. AS6 has been deleted few years ago. So AS6 and AS8 also no more exist in our accounting standards. Initially these standards were recommendatory. Initially accounting standards were recommendatory. Accounting standards were for application of general purpose financial statement of companies. So AS was issued for which type of financial statement? General purpose, that means not customized, not as per the specific need of the user. If you go to a bank, they may ask you information in some format. So it was not like that. It is general purpose. So users cannot demand a particular way of presentation, same format applicable for all the users. Is AS applicable only to companies? No. It is also applicable to non-companies. So you have studied in Inter, AS is applicable for even partnership, even proprietorship, even NGO, even not-for-profit companies. You have studied about not-for-profit companies. Under Companies Act, what is the section number for not-for-profit companies? Section 25 was, I think, under Companies Act 1956. Now it is Section 8. Is it right? Okay. Can accounting standard be used for tax computation purpose? Query is coming from the student. The answer is no. Accounting standard is not applicable for tax computation. For tax computation, you follow the tax laws. You follow the tax laws. So books of account does not make difference in calculation of your tax liability. Is accounting standard applicable for budgets? The accounting standards are not applicable for budgets, right? Because budget is an internal document. Management can write in budget whatever they want for their decision making. Budget is a decision making tool. Budget is not a financial statement for general purpose. So for budgets, for income tax, accounting standard or Ind AS cannot be used. Now came one of the most important years in the history of accounting standards. The government of India expressed its commitment to converge with IFRS, because globally IFRS was getting more and more popular. So now our government also thought that let us converge with IFRS, or at least we can issue similar standards. This commitment was given by our Honorable ex-PM Sri MMS Manmohan Singh in G20 summit, group of 20 countries. He had given the commitment there that India will also converge with IFRS, so that world over they will have the same standard. It becomes very easy to compare if everybody follows the same standard. Otherwise, Indian balance sheet was not comparable with European countries' balance sheet, and then they will not invest in India. So what has India decided in that G20 summit? That we will converge with IFRS rather than adopting IFRS. So what is the difference? Adopting IFRS means you will just take IFRS as it is, no change. Converging with IFRS means we will make some suitable changes according to Indian economic environment. Is it right? So Ind AS, what you learn, is almost similar to IFRS, except there are few differences. So if you just keep aside those few differences, then Ind AS and IFRS becomes the same. So IFRS adoption means same IFRS will be copied as it is, copy paste. But conversion means we will make some changes. What Indian environment suits will be added, and what Indian environment does not suit can be deleted. So adoption means applying IFRS as it is without any changes. Some countries like our friendly neighbor Pakistan and Sri Lanka have adopted IFRS. In India, Indian accounting standards were to be issued as modified version of IFRS known as Ind AS. So India is also a funny country. They have given a new name to IFRS, and that is called Ind AS. Don't ask why. Okay, so it is called Indian Accounting Standard, which is a converged version of IFRS, right? So we have now accounting standard also applicable for generally small companies, non-corporate entities, and now in India we also have Ind AS, which are applicable to listed companies and big companies. Company Accounting Standard Rules 2006 were formed. Now this, as I said, is a very landmark year. Companies Accounting Standard Rule 2006 were issued, and they notified the accounting standards that which standard will be applicable. Till then, till that time 1 to 29 were notified. Okay. So 29 standards were notified. They were made mandatory on certain companies. Companies were divided into, as you may have studied in your intermediate, level 1, level 2, level 3. For level 1, most of the standards were mandatory. For level 2, some exemption. For level 3, more exemptions. So this way, the standards were made mandatory under company accounting standard rules. And now came the most important year for Ind AS, 2015. So in 2015, ICAI has formulated IFRS Converge standard. So ICAI was ready with all IFRS Converge standard. They had gone through all the IFRS, they made all the changes which was required, and these are known as Indian Accounting Standard. So after a lot of discussion and deliberations, what name we should give? So somebody came out with this idea, Ind AS, and now it has been notified by MC under Companies Indian Accounting Standard Rule 2015. Wide notification dated 16 February 2015 after recommendation of NACAS. What is NACAS? National Advisory Committee on Accounting Standard. So that means now it has got a legal backing because it is notified under Companies Indian Accounting Standard Rule, and they made a list of applicability, when it will be applicable, to whom it will be applicable, right? So first thing is that Ind AS are modified version of IFRS, or you can say converged version of IFRS, not an adopted version of IFRS. So you can call it modified or converged version of IFRS. Then the question will be, why India has taken the convergence approach and not adoption approach? Because some changes were required to suit the Indian environment. Is it right? And to help the corporates. If you force them to adopt the full IFRS as it is, they might not be very keen or willing. So therefore they made some changes. These changes are popularly known as carve out, carve ins. Carve out means something has been left out, not included, and carve in means something has been added. So carve in means adding something to IFRS, and carve out means removing something from IFRS. So in some cases India has added something new, that is called carve in. You will see in Ind AS 103 they have added one appendix, okay, which we will discuss later, right now not relevant. And there are carve outs which you will find in Ind AS 1, some carve out is there. Then Ind AS 103, a simple example would be, internationally if there is a profit on business combination, that is you pay less purchase consideration and the value of the net asset is more, it is called gain on bargain purchase. It is called gain on bargain purchase. That gain on bargain purchase in IFRS will be shown in P&L account as other income, and what we will do in India, we will show it in capital reserve, so that it can't be distributed as dividend. So that is one example of carve out. Some more example we will discuss in the chapter when we will come to that. Is it right? So carve in means adding something new. Carve out means deleting something which does not suit the Indian environment. Is it right? Any query till now? No. So next is, high levels of disclosures are required for carve in and carve out. But then the standard says, wherever there is a carve in and carve out, the number of disclosure requirement will go up. So you have to give more disclosures where you have deviated from IFRS. So number of disclosures have gone up. So broadly, three categories of changes were made in the Ind AS. So all the carve outs or changes can be categorized into three. Which three? The first one was very simple. Various terminologies were changed. Terminology means, for example, I will give you easy example. What do we call in India a statement of assets and liabilities on a given date? We call it balance sheet. And what IFRS calls it? IFRS calls it statement of financial position. So when you will solve the question, in your many questions, the institute have also used SOFP instead of balance sheet. Both are same in your classroom and in your exam, because institute has taken some question directly from IFRS exams, ACCA exams, okay, and they forgot to change some words. One more example, statement of P&L account is used instead of statement of comprehensive income. So these are some minor changes. This we will not call carve out. This we will not call as carve out. Why these terminologies were changed? To make it consistent with the law. Because Companies Act says balance sheet. Companies Act says statement of profit and loss. So therefore my Ind AS should also say the same thing. Next is removal of options in accounting principles and policies. This is second change we have done. IFRS gives some options to you while preparing and presenting financial statement, but Ind AS has removed some of these options. A simple example would be, IFRS allows that you can prepare financial statement for 52 weeks or 365 days. IFRS allows that you can prepare financial statement for 52 weeks or 365 days. But what about India? Only 1 year. India allows year by year basis, 365 days only. There is no 52 weeks options for Indian companies. The other example is, one more example, that in IFRS, the statement of comprehensive income means what we call statement of P&L account. There are two options. One statement option which will have profit and loss and OCI, and two statement options. Two statement options means you will have P&L account in one statement and OCI related item, other comprehensive income item, in other format. So you can either show this or this. But Ind AS, how many options we have? Only one statement. First you will write income and expense item, and then below that you will write OCI items. So these are some minor changes, and now some major changes which are called carve in and carve out. First was change in terminology. Change in terminology are not carve in, carve out. Second was elimination of few options. Elimination of few options. Those are also not carve in and carve out. They are minor changes. But the major changes are called carve in, carve out. These changes are made considering the economic environment of the country. These changes were made considering economic environment of the country. One example for this will be in Ind AS 10. Suppose a company defaults the loan and the loan becomes repayable on demand. Company defaults on payment of loan, loan becomes repayable on demand. But before the balance sheet is approved by the board, before the balance sheet is approved by the board, you go to the bank with folded hands and say, please forgive me, I will rectify the mistake I have made, but don't make it a loan payable on demand. So if that loan was a non-current liability, it will remain non-current liability. If the loan breach has been rectified, but if it was an IAS 10, once you have committed the breach on the balance sheet date, it becomes a loan payable on demand. A loan payment on demand means it becomes a current liability. And therefore, even if the breach is rectified after the balance sheet date but before the balance sheet is approved, still the IAS 10 will say it will be a current liability. So what is economic environment of the country to do with it? If you put a liability as a current liability, your current ratio will get disturbed. Current ratio, current assets upon current liability. So if you put a liability in current liability, your current ratio will go down substantially, and then it will affect your further borrowing. Is it right? Investors don't look at a low current ratio very happily. They think that the company has a liquidity problem. But in India, we need to help our companies, our industries, okay? And therefore the government thought, let it be. If there is a breach, but the breach has been rectified, forget it. Let them show it as a non-current liability only, right? Because it will make an impact in the corporate financial programs and borrowing programs. Share prices can get affected. You are right. Then next is reasons for carve-in and carve-out. One reason we discussed about carve-in, carve-out was economic environment. The notified converged accounting standards are as a result of decision of the government to converge with IFRS. So why we have adopted IFRS, you have understood. Why we have converged to IFRS, you have understood. Our Prime Minister that time, Manmohan Singh, has made a commitment in G20 summit that India will sooner or later converge to IFRS. So we have decided to converge with IFRS. Why we have decided to converge with IFRS, that also we have discussed. Next point, sorry. One second. Next point. In the roadmap, it is stated that convergence will be adopting IFRS to suit the Indian condition and not adopting these standards. Our institute has prepared a roadmap. What do you mean by roadmap? Roadmap will guide you how to achieve the target, that is Ind AS applicability in India. So they have made it clear that we in India are not going to adopt IFRS. We are going to converge to IFRS, make some changes to meet the Indian economic requirement. So these are the differences between Ind AS and IFRS. That is why some differences will arise. The differences will be categorized as follows. The reason for differences will be categorized as follows. One, I have told you, to meet the Indian conditions. Examples also given. Second, for better presentation. So there may be some area where our institute believes that these changes are required for betterment to treatment under IFRS. These are again specific to Indian environment. Like changing the name to balance sheet, P&L account is better because we Indians, right, in our 11th standard accounts classes, we are taught balance sheet. And now if you tell them use SOFP, statement of comprehensive income, maybe the tax officer will also not understand it. So let us continue with the same terminology. Then the third is we have removed some options so that there is no misinterpretation, there is no confusion. Otherwise, if you give options to Indians, what do? They utilize or misutilize. Misutilize more often than utilize. No problem. And one more reason for carve out was facilitating first time adoption. What is first time adoption? Till now you are following AS, and then from a certain date you have to transit to Ind AS. From a certain date you have to transit to Ind AS. So what is the problem? Most of the transition provision requires that you must do the adjustment with retrospective effect. You must bring the fixed asset value as per Ind AS. You must bring the financial instrument value as per Ind AS. You must do business combination accounting as per Ind AS. For whatever has happened in the past, you have to assume as if you are following Ind AS from the beginning and calculate what would have been the balance on the date of transition. Is it easy? No, it's time consuming. Some fixed asset may be purchased 5 years ago, 10 years ago, but then you will have to bring them to Ind AS balance. It's very time consuming and difficult. So what in India we have done, we have given lot of relaxation for first time adopters. We have given lot of relaxation to the first time adopters so that they don't have the problem in migrating from old AS to Ind AS, right? Because in India we have lack of trained people who can help companies to shift from the old AS to Ind AS. Because all our senior people have learnt AS. New generation are learning Ind AS. So there is a gap of, there is a lack of talented people who can help companies to shift from AS to Ind AS smoothly. So therefore, one time relaxation. Just take the figure of your AS and treat as if this is the opening balance under Ind AS. Of course, there are some changes there also. Why this was done? Cost benefit analysis. So they thought that let us give one time relaxation. Hence, this is another reason for carve out. Come to para 4, convergence with IFRS. Ind AS is not an adopted version of IFRS. Ind AS is a converged version of IFRS. To converge means to achieve harmony with IFRS. Harmony means balance. Okay. Not going against the IFRS, but we are with IFRS. Ind AS and IFRS are not opposite. They are on the same page. Okay, they are on the same side. Only thing, we have made some modification to suit the Indian economic environment. So what is the technical definition of convergence given by the institute? So this blue font is ICI definition of convergence. Not required to be remembered for exam. Okay, I will just read it once for your satisfaction. To design and maintain national accounting standard in a way that financial statements prepared in accordance with national accounting standards comply with all the requirements of IFRS and draw unreserved statement of compliance with IFRS. So convergence with me are very much close to IFRS, and the financial statement prepared using Ind AS will be called as Ind AS compliant. Okay, and you can trust them, you can rely upon them. Convergent does not mean IFRS should be adopted word by word. Some places we have made changes, like for example, balance sheet in place of SOFP, statement of P&L account in place of statement of comprehensive income. In India, we have used the terminology true and fair in many of the Indias instead of fairly presented in IAS 1. So in IAS or IFRS, they say fairly presented, present fairly. We are used to which terminology? True and fair. We are used to true and fair wordings. So therefore, some places, some terminology have changed. The reason is to suit Indian economic environment, just because there are few changes made in some terminology like true and fair, balance sheet, statement of P&L account. That does not mean we are not following IFRS. That does not mean we are not following IFRS. So such changes do not lead to non-convergence with IFRS. Convergence is not a copy-paste exercise. Convergence is not a, adoption is a copy-paste exercise. But convergence is not. Why? Because in convergence, our institute have read paragraph by paragraph and they have checked, oh, this does not suit Indian environment. Let us delete it. Let us amend it. Okay, or add something. So therefore it is not a copy paste. They have applied their mind and then finally they have come out with Ind AS. It is a process of having IFRS customized for Indian environment. Like if there is a gain on business combination, we don't show it in other income in P&L account. Rather we show it in capital reserve. So that is to suit the Indian economic environment. If there is a breach of loan, which makes the loan payable on demand, but Indian environment says if the loan breach is rectified before the balance sheet, let the company continue to show it as a non-current liability, otherwise their borrowing program will get severely affected. European countries may be well advanced countries, they may not be bothered, but Indian government believes we need to support our corporates for whatever reasons. Now next is, to meet this objective, IFRS converged Ind AS were formulated. So I hope now you are convinced why convergence was required rather than adoption, while keeping this Ind AS as far as possible in line with the corresponding IFRS. Now if you see, in last 5 or 6 years, many carve-outs are also deleted. So there is very minimum gap left between Ind AS and IFRS. Certain departures have been made where it is considered absolutely necessary. And maybe in the next few more years, you will find that even those differences are eliminated. So maybe after a few years, you will find that there is no difference left only, except some terminology which might continue because the law requires you to use balance sheet, P&L account. So either law has to be amended or the Ind AS has to be amended. So why IFRS has been converged? Or the better question would be, why India shifted to Ind AS, which is nothing but converged version of IFRS. IFRS is a global standard. Before Ind AS, Indian company used to follow accounting standard. The financial statement based on accounting standards were not understandable by the foreigners. Is it right? Our format was different. Our recognition principles were different. It was not trusted by the others. They cannot compare Indian balance sheet with a European balance sheet, Indian P&L account with the European P&L account, because they were all based on different standards, different recognition, different measurement, different presentation, different disclosure. How do I take a decision? How do I take a decision if I can't compare? So corporates were losing out to other countries. They were not able to raise funds because the investors were not able to understand, interpret or compare your financial statement with others. Then the government finally realized, no, we should also have a high quality, globally recognized standard. High quality, globally recognized standard, and therefore they decided to go for converged version of IFRS. Second point will emerge out of the first point only, comparability. Now you can easily take, for example, Tata Steel balance sheet and Mittal Steel balance sheet, keep them next to each other and you can compare, because they both will be based on similar standards. Mittal Steel is based on IFRS, Tata Steel is Ind AS, which is converged version of IFRS. So that becomes easy. Comparison becomes easy. This is just an example. When comparison is easy, people can take decisions also easily. Is it right? This will help in international cash flow. More and more Indian companies are now going to other countries to raise the funds. Now, if the foreigners are convinced, foreign investors are convinced that yes, these are high quality standard, we can rely on the figures, welcome, they will be willing to invest in India. This will also be beneficial to the Indian regulators also. Okay, over a period of time, as more and more companies will adopt Ind AS, regulators will also find it easy to understand the numbers, to make policy decisions. Another benefit is consolidation. Now I will tell you a very practical example. Suppose there is an Indian company, it has got subsidiaries in USA, in UK or Japan. Now, Indian company was following accounting standard. US company is following US GAAP. UK company is following say UK GAAP. UK GAAP. GAAP means the local standards are called GAAP. And then Japan was following IFRS. Japan was following. Now this is the parent company. As per Companies Act, you have to do consolidation. So what will you do? Ask subsidiary to send the balance sheet which is in US GAAP, convert into AS. Ask this company to send the balance sheet, convert into AS, convert into AS. And this exercise you have to do quarterly because it's a listed company. Indian company is a listed entity. So they will have to do this whole exercise how many times? 4 times quarterly and annually also 5 times. Now imagine people working in the accounts department of this Indian parent company, they'll get frustrated. They will not get any leave also because this or that convergence is continuously happening. Very time consuming. Okay, very resource consuming. Lot of productive man hours were lost just because you need to convert from one format to another format. So what they have decided, let us follow one standard. So now globally most of the countries have adopted IFRS. So you can just do the simple consolidation. Take the property, plant, equipment figure of subsidiary which may be located in any country, add it to your figures. Easy? Yes. And even the US GAAP and IFRS differences are getting reduced. The difference between US GAAP, US is saying our standards are supreme. So they are not going to adopt IFRS or converse to IFRS. But slowly and slowly, the US standard setters, IFRS standard setter, they usually meet and try to make common standards. Try to make common standard like this Ind AS 115 or revenue standard, leasing standards. Slowly and slowly they are very similar in US GAAP as well as IFRS. Now we'll come to one of the most important paragraphs, that is called applicability of Ind AS. Now we are not going to go to applicability in 2016, 2017, 2018, etc. Not required. We have to see today. Today, to whom Ind AS are applicable? That is a relevant question now. Not to whom it was applicable in year 2016 when Ind AS was introduced. Is that question any more relevant now? No. So today, if you go for an interview, they will not ask you in on 1st April 2016 to whom Ind AS was applicable. They will ask you, this is my company's data and you tell me, is Ind AS applicable to us? Is it right? This kind of question they will ask you in the interview. Then first is listed companies. All listed companies in India on recognized exchange like BSE, NSE, and companies which are in the process of listing any security. That means you have filed the application with SEBI or regulators that we want to get our listing done, and all the paperwork have started. Okay, on of any instrument, whether it is equity or debenture or bond on any exchange. So now all listed companies, because why listed companies have to follow Ind AS, they are using public money. They are using public money. Okay, and public needs high quality standards. So Ind AS are high quality standard as compared to our old accounting standard. Second, now it is also applicable to NBFCs which are listed or NBFCs which are in the process of listing. So all listed NBFCs will come under the net of Ind AS. Now why it is written as a separate point? Because earlier NBFCs were given some exemptions, but then they are also brought under Ind AS. So these companies like Bajaj Finance, Muthoot Finance, Mannapuram Finance, all such finance companies, okay, whose main job is to raise funds and give loan, etc., for different purposes, will also come under the net of Ind AS if they are listed or in the process of listing. Then note, banks and insurance companies. For banks and insurance companies, Ind AS is not applicable. Now for your information, earlier it was proposed that banks and insurance company will apply Ind AS from 1/4/2020, but then 1/4/2020 Corona came, okay, and now that plan has been deferred. Then your question will be, now what is the new date for applicability of Ind AS to banks and insurance company? So there is no date specified as on today. Now what about the unlisted companies? Whether unlisted companies are also required to follow Ind AS? Yes. So what is the criteria for identifying such unlisted company? The criteria for identifying unlisted company is their net worth. Net worth should be more than 250 crore on the 31st March of the previous year. So every year you get your financial statement audited, and if that audited financial statement shows that your net worth has exceeded 250 crore, from immediately next year you will start applying Ind AS. And how do you compute the net worth? Now this can be a question for you in the exam, that check the applicability of Ind AS on the basis of net worth criteria. So I have given a long list of items which you need to add or less. First, you will take equity share capital. If it is given into you, add preference share capital if treated as equity. If treated as equity, so you can add, because under old AS there was no distinction between preference share equity and preference share debt. That is there in the Ind AS. Ind AS says preference share can be equity or preference share can be debt. So student can add securities premium, add free reserve. Free reserve means which can be distributed for dividend purpose. So general reserve, P&L account, retained earning, dividend equalization reserve. Then add, wait, capital reserve arising from grant received on promoter's contribution. Other capital reserve will not be considered, but you have studied, I think, AS12, government grant. There you have studied grant in the nature of promoter's contribution is credited to capital reserve. Have you studied grant in the nature of promoter's contribution will be credited to capital reserve? Now, if suppose your previous standard had credited capital reserve, so it is appearing in your books, add that also. IFRS has allowed this. IFRS has allowed the capital reserve on promoter's contribution to be treated like a free reserve. To be treated like a free reserve. So this is one thing which you have to know. And suppose in the balance sheet you have accumulated losses like debit balance of P&L account or any reserve with negative balance, deferred expenditure and miscellaneous expenditure not written off till now. So maybe in the balance sheet you may have, under the old standard you can have discount on issue of debenture, discount on issue of share, for example, some companies preliminary expenses, then all such items will be deducted. So you will get the net worth, and if it exceeds 250 crores, immediately from the next year the Ind AS will become applicable to you. Do not include any other capital reserve or specific reserve. Do not include any capital reserve or any specific reserve that we create. For example, we create debenture redemption reserve under Companies Act, capital redemption reserve, or any other reserve will not be considered. Then as per IFRS, grant in the nature of promoter's contribution is like a free reserve and hence can be included in the net worth calculation. What about share forfeiture account? In your CPT or foundation intermediate we were taught, if a shareholder does not pay the uncalled amount when the company makes the call, his share is forfeited and the amount that he has paid is credited to an account called share forfeiture account. Will that also be forming part of net worth? No. Next question, whether net worth will be calculated as per standalone balance sheet or as per consolidated balance sheet? So the answer is it will be calculated as per standalone balance sheet. We have to check the applicability on company, particular entity. So therefore standalone balance sheet will be taken. Now, very interesting point. Suppose you have started applying Ind AS. From 1/4/2021 you started applying Ind AS because you had previous year on 31st March 2021 your net worth was more than 250 crores, correct? So this year you will apply. What happened? Your net worth has gone down below less than 250 crore at this point. So much corona that you incurred so much losses, your net worth has gone below 250 crore. Now the company says, since my net worth has gone below 250 crore, from next year 1/4/2022 I will not apply Ind AS. Can I say that? Huh? Can I say that? No. Once Ind AS, always Ind AS. Once Ind AS, always Ind AS. So what is the poem you have to know? Once Ind AS, always Ind AS. So later on, it doesn't matter that whether your net worth is more than or less than 250 crore. You have to continue to apply Ind AS. Similarly, a company, there are two ways in India a company has to apply Ind AS. It was a listed company. it was a listed company till 31st March 2021. And now this company says we have got delisted. The company can get delisted. It can request the stock exchange, SEBI, and subject to the rules and regulations in India, a company can go for delisting. Okay, they don't want to remain a public listed company because so much of compliances are there in a listed company. It was following Ind AS till this date. Now it says I will not follow Ind AS because I am no longer a listed company. And my net worth is less than 250 crore also. What is your answer? Once Ind AS, always Ind AS. So whether your net worth falls below 250 or whether you get delisted, once Ind AS, always Ind AS. Then net worth will be checked on the last day of the previous year. That means take the previous year audited balance sheet. It has to be audited balance sheet, and then you check the net worth. Net worth formula was printed above. Then companies meeting net worth criteria as on 31st March 2020 will start applying Ind AS from 2021 onwards. So your life will become Ind AS from the next day only. Then what about private limited company? Will a private limited company also follow Ind AS? The answer is yes. For unlisted company, the net worth criteria is there. So if suppose you meet the net worth criteria more than 250 crore, let us say for example Serum Institute is unlisted company, but its net worth is more than 250 crore. Will it apply Ind AS? Serum Institute of India, located in Pune, producing vaccine for the globe. Yes, it will. Whether Section 8 company, that means non-profit companies, but registered as corporate, will they apply Ind AS? Yes, if the net worth exceeds 250 crore. Can a company voluntarily adopt Ind AS? Yes. So next point is there are companies who are allowed to adopt voluntarily Ind AS. But once you adopt voluntarily, then there is no going back. Once Ind AS, always Ind AS. So you can't go back. Are Ind AS applicable to government companies? Yes, if they meet the applicability criteria, either they should be listed or the net worth should be more than 250 crore. So even government companies, NTPC, Coal India, okay, MMTC, everybody will come under this Ind AS net as long as either they are listed or their net worth is more than 250 crore. Then SEBI has notified that real estate investment fund will also follow Ind AS. So this is specific notification of the SEBI that in India there are some real estate investment funds, that is they raise funds and they invest in real estates. Like you want to invest in real estate but you don't know whom to trust. Okay, it's better to invest in a real estate investment fund. They are run by professionals, so they know how to purchase land, how to invest in real estate, how to do the dealings. We as a common man are not competent to deal with those big builders and developers. So you really don't know how much money this property should cost, when should I buy, sell. So if you want to invest in real estate, instead of doing it directly, you can invest through real investment funds, which is a big business now in India. And then similarly, there are funds which invest in infrastructural projects. So if you want to enjoy the benefit of the infrastructure growth story of India, then you can invest through infrastructure investment fund because they raise money from large number of people. Therefore, SEBI says you also follow Ind AS. Point number next. special cases. Whenever Ind AS are applied, whenever Ind AS are applied, then all entities in the family will also apply Ind AS. All entities in the family will also apply Ind AS. What do you mean by family? It means if A Limited applies Ind AS, following entities will also apply Ind AS. The subsidiary, okay, subsidiary will apply Ind AS. Associate will apply Ind AS. Joint venture will apply Ind AS. Parent company will also apply Ind AS. Parent will say nalak subsidiary because of you, I also have to apply Ind AS. Then if there is any LLP, limited liability partnership, that limited liability partnership will also apply Ind AS because the financial statements are consolidated. Why are these required? Because their financials are consolidated. If a company is a partner in a partnership firm, if a company is a partner in a partnership firm, that partnership firm will also apply. Why? Because their financial statements are consolidated with the company X Limited or A Limited in our example. Okay. So who all will apply Ind AS? The subsidiary, the parent, associate, JV, LLP and partnership firm, where A Limited is a partner. So this is another potential question for you. They will give you a case study and they will ask which of these companies, which of these entities are required to comply with Ind AS. So even though you may not be listed, you may not have net worth of more than 250 crore, but if your parent or if your subsidiary has net worth above 250 crore or listed, you also start applying Ind AS. Okay. So these people have to apply Ind AS because X Limited is either a designated partner in LLP or X Limited is investor and K is associate, or P Limited is a partnership firm where Y is partner, then Z Limited is a subsidiary of X, so Z has to apply, B Limited is a joint venture, so B has to apply, Y has to apply because Y is the parent entity of X. So if these people are associated with this company in the center, all these companies will also start applying Ind AS. Is it right? So its applicability is not just to few companies in India. Theoretically speaking, looks few companies because listed companies are only few thousand. Companies above 250 crore net worth also maybe few thousand only, not few lakhs, maybe just some thousands. But because it is also applicable to their subsidiaries, subsidiary may have net worth of 2 crore rupees also, it becomes applicable. Associate, many of these big corporates have hundreds of associates, tens of associates, all those associates will apply. Reliance have, let's say, 100 plus subsidiaries, all those subsidiaries will apply. Larsen and Toubro, 100 plus subsidiaries or many subsidiaries, if not 100, say 15, but those 15 will also apply. And as per the definition of a subsidiary of a subsidiary is also a subsidiary. So even those subsidiary will also apply. So that way, the more and more companies in India will come under Ind AS net. Okay, and therefore you people should learn, master this subject because as I said, there is a huge demand for people who know Ind AS. Now some queries will come. You said banking and insurance companies are not required to apply Ind AS. Subsidiary is a banking company. Parent may be an Ind AS company. Parent has a subsidiary, a banking company. Okay, just imagine. don't ask me an example, I can't really visualize immediately. So subsidiary is a banking company. Now banking company are exempted from Ind AS. So now what banking company will do? So banking company or insurance company which is a subsidiary of a company which complies with Ind AS will have to prepare two set of financial statement. Which two set? One as per your banking company's rules which you have learnt in your intermediate. Insurance company will follow whatever rules are applicable to insurance company, but they will have to also prepare financial statement as per Ind AS so that it can be consolidated with the parent company, because you can't consolidate two financial statement based on two standards. Our Ind AS 110 says all subsidiaries will follow the same accounting policy as followed by the parent entity. Is it right? So therefore their life will be difficult if they are subsidiary of some company which follows Ind AS. Two sets they have to prepare. It will not apply Ind AS, but it will provide relevant financial data in accordance with the Ind AS followed by the parent for the consolidation purpose. So they will have to give the Ind AS data to parent company. Now reverse case, parent is a banking company. Parent is a banking company. In India there are many such cases now. Say ICICI Bank, it is a subsidiary. So parent will not apply Ind AS, but the subsidiary is applying Ind AS. The subsidiary is applying Ind AS. Now what will happen? That subsidiary will have to prepare two set of financial statement now. One, because it is an Ind AS company, subsidiary will prepare financial statement as per Ind AS. But parent is not an Ind AS company. So it will have to prepare another set of financial statement based on the accounting policy of the parent, which is accounting standard in India right now. That will be required for consolidation. So in India that kind of problem will be there now for banking and insurance company. If they are subsidiary, they will have to prepare two sets. If they are parent, their subsidiary which are Ind AS based company will have to prepare two sets. One more problem comes, overseas parent company. What is overseas parent? Let us say Apple has a subsidiary in India which is falling Ind AS because its net worth is 250 crore and above. But where is Apple? USA. Will Apple USA also follow Ind AS because your subsidiary follows Ind AS? You have read the rule. If subsidiary follows Ind AS, parent will follow Ind AS. But parent is not an Indian company. Will Ind AS extend to a non-Indian company which is not registered under Companies Act? The answer is no. Apple USA will say, I will not follow Ind AS, do whatever you want to do. We can't do anything. So they are not compelled to follow Ind AS. We don't require also their financial statement. They are not in India. Now one reverse problem. Overseas subsidiary, but parent is in India. Now we'll take a reverse case. Infosys India has a subsidiary in USA. Infosys follows Ind AS. Will that subsidiary in USA also follow Ind AS? No. They will follow US GAAP. But the subsidiary's financial statement have to be consolidated with Indian parent. So they will prepare two sets of financial statement. So these are some practical challenges you will also see if you work in a big firm or a big company which have got overseas parent and overseas subsidiaries. They have to do the conversions. So they will take the US based financial statement, do the conversion as per Ind AS, and then it will be consolidated. So these are the practical problems which will come. Banking company. Once again, banking company are right now not required, but very soon they may be required, as RBI is after their life that you need to follow Ind AS also. But for some reasons the applicability has been postponed. So this circular was issued on March 22, 2019, and right now we really don't know from which date it will be applicable. Same thing for insurance company and insurers. So implementation of Ind AS has been postponed till further notice. The reason here could be that one IFRS 17 is for insurance company, and a counterpart standard we are also in the process of finalizing, Ind AS 117. So once that Ind AS 117 is finalized, issued, then this insurance company will also be required to adopt Ind AS, because right now even if they adopt, insurance business is very different from a normal business. Is it right? They have many technical terms, very technical way of presenting their things, and therefore there is a comprehensive standard which will be issued very soon, and then it will become applicable to insurance companies also. What about voluntary adoption for NBFC, banking and insurance company? Suppose a bank says, okay, we want to adopt Ind AS voluntarily, we are good companies. Insurance company says we want to adopt voluntarily, or an NBFC which is not listed, not in the process of listing, can they voluntarily adopt Ind AS? The answer is voluntary adoption is not allowed for NBFC, banks and insurance. But if suppose there is a manufacturing company, they want to adopt voluntarily, can they do it? Yes. Can we do it? Ind AS? Yes. We can also follow Ind AS, but of course I am not going to follow. What about companies listed on small and medium enterprise exchange? In India there is one more exchange called SME exchange, where small companies get listed. Okay, that is those companies whose funds requirements are 2 crore, 4 crores. So BSE will not allow them, because such small companies are not traded in BSE. So what they do, they list themselves on SME exchange of India. Our standard says companies listed or in the process of listing. Now the problem will be, there may be thousands of companies which are listed on SME exchange, but they are very small companies. They don't have good accountant for basic entries also, and you will tell them then you apply Ind AS. So therefore for the time being, such chotu companies which are listed on SME exchange are not required to follow Ind AS. So SME exchange listed companies are exempted, but those which are listed on our two main exchanges, BSE and NSE, they have to follow. Now there is a flow chart given at the end of this chapter, end of the chapter, okay, where this flow chart is given. So I will quickly explain this to you. Pay attention, very easy. First you check whether it is an insurance, banking or NBFC company. Then under that also we will divide into two, bank and insurance on one side, NBFC on other side. So if it is a scheduled bank, excluding regional, rural bank, NABARD, Exim Bank, SIDB, insurance. If the answer is yes, these are banks and insurance companies, postpone till further announcement. Okay, and then you take this arrow, go here. Right now they will continue to apply the existing accounting standard. But then if it is an NBFC, here we are here, I'll take a different color pen. Come to left side. Is the company's net worth equal to or greater than rupees 500 crore? Yes. Applicable from 1st April. Okay. Then is the company's net worth less than 500 crore but equal to or greater than 250 crore, or whose equity or debt securities are listed or in the process of listing? Yes. Then NBFC will also come under the Ind AS net. So listed entity or net worth 250 crore and above, or in the process of listing NBFCs, they have come under the Ind AS net, right? But suppose you are neither bank, nor insurance company, nor NBFC, then earlier there was a criteria of 500 crore. If you exceeded 500 crore net worth, applicability will be from 1st April 2016. And then after that, now if you are either listed company or net worth is more than 250 crore, then from 1/4/17 all such companies will become Ind AS company. But if you are neither listed nor net worth more than 250 crore, not a bank, or you are a banking company, or you are an insurance company, then you are not required to apply Ind AS. So if they ask you a reverse question, who is not required to apply Ind AS? Who is not required to apply Ind AS? So you will say unlisted companies having net worth less than 250 crore, banking companies, insurance companies, and non-corporates, they are not required to comply with Ind AS. So partnership firms are not required unless an Ind AS company is a partner in that partnership firm. Is it right? So should we take few questions on Ind AS? Louder, yes. Question number 1 in your book. Question 1, a non-listed, non-financial company is not covered under Ind AS applicability criteria. Non-listed, non-financial company is not covered under Ind AS applicability criteria. It desires to apply Ind AS voluntarily for CFS purpose. So see, so many queries come in the mind of people. To avoid tax and revenue sharing issues, it will continue preparing SFS as per the 2006 accounting standard. That means very funny. I will call it a very funny idea. For SFS, they want to follow accounting standard, but for CFS purpose, they want to follow Ind AS voluntarily. It's a non-listed company, non-financial company, so it is not covered under Ind AS. It's not covered under Ind AS. So tell me, are you allowed to follow AS in SFS and Ind AS in CFS? So some queries like this comes in the mind of companies, but the answer is no. You can't follow two set of standards for SFS and CFS. And then how do I present the answer? Presentation of answer, you will not write no for both, something like that. Write the answer in a logical way. So you will write the roadmap requires Ind AS application at the company level for SFS and CFS purpose. As I have told you, our institute have issued a roadmap. That how Ind AS application will take place in India. So they have said you have to follow Ind AS for both CFS and SFS purpose. Plus Companies Act also has a paragraph 129(3). If you know, very good, that CFS and SFS will be prepared in the same format. So your answer is over. Roadmap does not allow you two format. Companies Act does not require two format. So considering this requirement, the student will write, it is not possible to adopt Ind AS only at CFS level while the company continues SFS in accordance with 2006. Rather, the same accounting standard will be used for both CFS and SFS. So can you write your answer like this? Visualize. Can you write like this? If yes, welcome. You are a good candidate for passing this exam. Then there is one more doubt coming in my mind. An Indian company is not covered under Ind AS applicability criteria. An Indian company is not covered under Ind AS applicability criteria the company is not interested in applying Ind AS in entirety. However, it wants to apply certain Ind AS on a voluntary basis. For example, it wants to apply Ind AS 109 financial instrument, which will allow it to fair value its investment. For other matters, the company will follow Ind AS, company will follow 2006 AS, means old AS. Is it permissible? Is it permissible? Yes, answer. Is it permissible? It says for PPE, I will follow AS. For inventory, I'll follow AS2. But for investment, I will follow Ind AS 109. This is what they are proposing. For all other items, government grant, PPE, inventory, okay, revenue, AS. But for investment, I will follow Ind AS 109. Can you do this kind of exercise? The answer is no. Either you follow AS or you follow Ind AS in totality. However, where we don't have a guidance under accounting standard, if there are some transactions for which there is no guidance in the accounting standard, then you can follow. Okay. So I will give you the answer, how to present the answer. That is also an important task before a student, how to present the answer. One of the reasons why our students don't get good marks in general in our whole country, when I look at their papers, the presentation part is slightly missing. He will simply say not applicable, yes applicable, don't know applicable. You have to write some background. Roadmap makes it clear that a company needs to apply Ind AS or 2006 AS in entirety. That sentence satisfies the institute, that you know either full or none. Okay, either full or none. There is no midway. Companies are not allowed to apply mix and match policy. You have not gone to a restaurant and ordering for a thali. Okay, bring dal also, paneer also. I don't want chapati. Okay, I don't want rice. I want pizza. This is Ind AS. Full or none. Eat or don't eat. Okay. Companies are not allowed to follow mix and match approach. Consequently, the proposal is not tenable. Not tenable means not acceptable. Then, however, it may be noted that 2006 AS does not prescribe specific accounting for certain transactions, events and condition. Very important line. This will show that you know your accounting standards in depth. What if there is no treatment given under accounting standard 2006? Then you can use Ind AS. For example, if you give Indian GAAP do not contain comprehensive accounting for service concession arrangement. Do you know what is service concession arrangement? It is basically public-private partnership for construction of infrastructure, where you construct a road, but the road does not belong to you. The road belongs to government. Government gives you a right to collect toll for 20 years. So that is called service concession arrangements. Do you have any accounting standard or guidance note dealing in detail, comprehensively with such arrangements? The answer is no, but Ind AS 115 comprehensively deals with service concession arrangements of different types. Therefore, for service concession arrangement you can follow. But what about the investment? Don't we have a standard on investment in accounting standard? Yes, we do have. We have AS13. Answer is printed in the notes given to the student in the classroom, so you don't need to write. The Ind AS 13 has provision for investment. In that case, I cannot apply Ind AS 109. Is it right? Otherwise, company will do the fair valuation, increase the value of investment. And for some item where the value has gone down, they may just follow your old AS 2006. So cherry picking is not allowed. What is cherry picking? Just like when you go to a shopping mall, you take a bag and you do cherry picking. You want something, you put it in the bag. That is not allowed. Okay. So for service concession arrangement, you can, but for investment, you cannot. Okay, one more interesting question on the screen. So please answer everyone. Question number 5. Does the requirement also cover fellow subsidiary companies? That is subsidiary of the holding company and associates and joint venture of the holding company. So very interesting question. Consider the diagram below. So all of you please see this diagram on the screen. Diagram on the screen. Keep the mobile or computer screen in front of you. You are a parent company here. This parent has a subsidiary, list company limited. Okay. Then this list company has one direct subsidiary under it and associate or joint venture under it. This company, list company, has a parent. Parent has one more subsidiary, FS Limited. Then this parent has one more associate, AS Limited. This fellow subsidiary has one more subsidiary, SS Limited. Question is, list company limited has come under Ind AS. Apply your intelligence. This question may not be there in your study material. List company limited has come under Ind AS. Who all will apply Ind AS? Who all will apply Ind AS? Yes, parent will apply. Very good. Subsidiary will apply. Yes, very good. Joint venture of list company will also apply. Yes or no? But the question was whether there is another subsidiary of a common parent, will that also be applied? Will that also be applied? The answer is no. Although the views are divergent, standard is silent on that. The standard is silent on that, views are divergent, but why will this company apply? It will say list company is neither my parent, nor my subsidiary, nor I am an associate, nor I am a joint venture of list company. So FS Limited, the company in the center which I am circling right now, it is neither parent, nor subsidiary, nor associate, nor joint venture. Will it apply? No. The only connection is that they have a common parent. Same question, whether AS Limited, who is an associate of parent, will it apply Ind AS just because list company applies? Now some student can also argue like this, because list company applies, parent applies, and because the parent applies, this should also apply. That is another way of argument. Our standard sitter never thought about all these complications. But the answer is, this will not apply. Parent has forcefully come under Ind AS. Parent has forcefully, because its subsidiary has come. Is it right? Parent is neither listed nor having net worth of more than 250 crore. So the answer would be no. But now there is a problem. What is the problem? This parent company at the top is now going to apply Ind AS. Since it is going to apply Ind AS, it will prepare CFS under Ind AS now. To prepare CFS under Ind AS, these subsidiaries, this associate must also provide data under Ind AS. Now what is better? Tell me. As a group CFO, suppose you are a group CFO of parent, although they have a choice These three entities have a choice not to follow Ind AS and continue to follow accounting standard. But for consolidation purpose, you have to prepare Ind AS based data. What will you do as a group CFO? Ask them to follow Ind AS voluntarily. Otherwise, your accounts department of these three companies will have double role. First, they will prepare AS based financial statement. Then they will have to also do conversion from AS to Ind AS so that parent can do the consolidation. So once this parent requires consolidation, means everybody in the group will have to prepare Ind AS based financial statement. So theoretically, Ind AS is not applicable to, what will be your answer? Theoretically, Ind AS is not applicable to these three, but practically they will follow Ind AS. Okay, otherwise prepare two sets of accounts. So now I will tell you how to present the answer. Remember, one of the major reasons why students are not getting marks is lack of good presentation of answers, especially theory answers. Numerical answers are okay. You have to write the same thing, but theory question has to be presented well. So in our class, we will do a lot of theory question writing practice also. Right now I am giving you the answer in writing, but not every time. Ind AS is mandatory for companies which meet listing criteria, net worth criteria, and they are holding subsidiary, joint venture or associate. So joint venture, associate, subsidiary and holding company will follow Ind AS if you are following Ind AS either because of listing requirement or net worth requirement, and not because your subsidiary has come under Ind AS. Since list company meets the criteria for Ind AS adoption, list company meets the criteria for Ind AS adoption, its holding subsidiary, joint venture, associate company, namely parent sub limited and AGV limited also needs to adopt Ind AS from the same date. That is simple. With regard to other subsidiary, means which other subsidiary we are talking? Fellow subsidiary, FS limited, and subsidiary of FS, SS limited, and associate company of parent, which is AS limited. One view is that since parent is covered by Ind AS, they will also be covered by Ind AS from the same date. The application of this view will facilitate the preparation of Ind AS CFS by the parent company. So this is a theoretical view that they should follow CFS. But if you apply strictly the provisions of applicability, they are not. However, the second view is that the roadmap is applicable to holding subsidiary, JV or associate company only if the companies meet net worth or listing criteria. The same requirement does not extend to company which adopt Ind AS just because they are holding subsidiary, JV or associate of the companies meeting the net worth or listing criteria. So this is the answer we will write. However, you will put your gyan also in the answer. Not mandatory to prepare Ind AS for statutory reporting. But problem will arise when you do the consolidation. Even though you are not mandatorily required to follow Ind AS, if you have to do the consolidation, then for consolidation purpose, these other subsidiaries, FS limited, SS limited and associate AS limited, they will have to give consolidation data for under Ind AS. So what is better? Practically make these other three companies also adopt Ind AS voluntarily for group reporting purpose. It will helpful. Now dear student, will come to accounting standard. So first of all, I want to make it clear that accounting standards are not applicable in your syllabus. So we will just spend few minutes, maybe 1 minute only, to discuss the accounting standard, because there will be reference of accounting standards in some chapters. Like for example, Ind AS 101, first time adoption. Before adopting Ind AS, you are following AS only. So you need to know what is AS. So AS means the standards which were notified under Company Accounting Standard Rules 2006. Those companies which will not follow Ind AS will follow accounting standard notified under Company Accounting Standard Rules 2006. So which means right now in India, accounting standards will be followed by which companies? Banking and insurance, unlisted companies who do not exceed net worth criteria of 250 crore, then non-corporates. But if a non-corporate like a partnership firm, LLP, if their investor or their parent company follows Ind AS, then these non-corporates like partnership and LLP will also follow Ind AS. Some examples to demonstrate the applicability. If A Limited, an Ind AS company, and B Limited, an AS company, are partners in AB and company. Interesting. In AB and company, there are two partners, A, B. A follows Ind AS, B does not follow Ind AS. What will AB and company do? So AB and company is now in a confusion. One of my partners follow AS and one of my partners follow Ind AS. What will I follow? What will this company follow? Come on. The answer is Ind AS, because the moment one of your parent company or investor follows Ind AS, you will also follow. Next question. If both A and B follow AS, both A and B Limited are AS based company, of course now partnership firm will also follow accounting standard. So the life of a partnership firm will become difficult if some partners follow AS, some Ind AS and some US GAAP. Everybody will want the data in their principle, their GAAP. Anyway, now Ind AS are applicable to three types of entities in India. They are divided into level 1, level 2, level 3. Level 1 entities, no exemption, follow all standard from 1 to 29. Level 2 are given partial exemption. Partial exemption in applying some standards like 3, 17, 15, 19, 20, 28, 29, 21, 23, 27, 25. Maybe basically disclosures etc. are exempted. And level 3 are very small companies, so they are given exemptions from many more standards like 18 and 24 is also added in this list. Do we need to remember? And not at all, only for general awareness. So banking and insurance company will automatically come under level 1. Other level 1 entities will be based on their turnover criteria or borrowing criteria. If turnover is more than 50 crore in previous year or borrowing is more than 10 crore at any time in previous year, then they are called level 1 entities, no exemption. Level 2 entities turnover is more than 1 crore or borrowing is more than 1 crore at any time during the previous year. Good news. In your exam, accounting standard is not asked. Now your syllabus is fully Ind AS. Next is, what are IFRS? What are IFRS? How are they different from accounting standard? Already in the beginning we have covered this. Who issues IFRS? IASB. IFRS or IAS are issued by IASB, International Accounting Standard Board, and this form the basis for Ind AS. That is, Ind AS are inspired from IFRS. And as you know, in India we will take the IFRS, our institute will go through it and they will make some carve out if necessary. Is it right? They will change the nomenclature of some items if they feel like. IFRS are principle based standard. So one of the important thing about IFRS is that they are principle based, not rule based. So what is the difference between principle based and rule based? Principle based means they will give you a general guideline, broad guideline, like the principle will be inventory, a PP should be depreciated over its useful life. That is what principle. Depreciation should be provided so that the depreciable amount is systematically allocated over the useful life. But they will not force some method upon you. If it is method forced upon you that you have to take 10 years as life, you have to follow SLM, it becomes rule based, like your income tax is a rule based. In income tax, do I have a choice to decide the depreciation rate? That is rule based. Similarly, US GAAP has lot of rules where we as an accountant don't have any flexibility, but this IFRS gives flexibility because it is principle based. Since it is principle based, judgments will be required at certain times. Okay, but please do not misuse judgment. More focus on reporting rather than accounting. IFRS says let us focus more on reporting. Let us make investor gain from the balance sheet and P&L account. It is not just to comply with your tax return or your company's return, but to make it more useful for the investors and the other users of the financial statement. IFRS are applicable in separate as well as CFS. One of the main features of IFRS is these are focusing more and more on substance rather than form. That means look at the economic reality of a transaction, not just the form in which the transaction appears. Sir, give me an example. Sir, give me an example. That is why I have set down. Suppose goods are sold. Okay. And the payment will be made after 3 years. Say 150 rupees. What is the accounting entry will pass here on day 0 when the goods are sold? Will you write like this? Debtor account debit to sales account 150, 150. This is what have been taught to us in my 11th standard accounts classes. My teacher Charanjit told me debtors account debit to sales account. Is it right? I said he's paying after 150. He said don't bother. Invoice says 150, 150. I says no, there is a time element also. If I purchase by paying full payment now, I will get 30 rupees discount. The supplier will say, okay, you are paying now, I will give you 120 at 120. So that means the 30 rupees is an interest component. He is charging me interest. Where is the interest in this accounting? But Charanjit madam said, this is what you have to do. When I came to final, the life has changed. Now will not pass entry like this. I will calculate the present value of 150. So 150, suppose my opportunity cost is 10% to the power 3. 150 on your calculator. 150 divided by 1.10 to the power 3 equal to, come on, louder. You're not answering. 150 divided by 1.10 equal to, yes, come on, answer. 112.69. After a lot of efforts, finally we got the answer, 112.69. Now the answer will be, when we sell the goods, I will just write debtor account debit 112.69 to sales account 112.69 because that is the cash price of this good. The difference represents the interest element. So when I am charging interest from the customer, my accounts, my financial statement should also show the same. Then every year what I will do, I will record the entry for interest income, debtor account debit to interest income. debtor account debit to interest income, debtor account debit to interest income 3 times. So first year it will be 11.27. What will not calculate after this, but idea is to make you understand that every year interest will be calculated and interest will be recognized as interest income, not as a sale revenue. So under accounting standard it gets recognized as sale revenue, but here we are recognizing it as some portion as sale revenue. What is sale revenue and what is finance income is recognized as finance income. So that is an example of substance over form. Now next is, there is a financing element inbuilt in the price. So in such situation I need to segregate the sale part and the interest part. So if goods are sold at 100 rupees for a normal 3 months credit, it's okay. But if the same good is sold for 110 and the supplier gives you 15 months credit, it means he is charging you 10 rupees interest. So while doing the accounting, I have to book the revenue as 100 rupees and interest income as 10 rupees. That is the example of substance over form. Another interesting part about IFRS is that, which many people may not like, because we are used to concept of conservatism, we are used to concept of prudence. Right from 11th standard we are taught concept of prudence, concept of conservatism. Anticipated loss can be recognized, anticipated gain cannot be recognized. But now IFRS is changing our base altogether. It says in some cases like financial instrument standard, you can recognize an appreciation in the fair value of the investment in the P&L account. Is it right? So more and more Ind AS will require you to bring assets and liabilities at fair value on the balance sheet, so that you know what is the real net worth of this company, what is the real value of this company. If the assets and liabilities appear at historical cost, by looking at balance sheet I don't know what is the real worth of that company. Plus this standard, all IFRS standards, they have also introduced the concept of time value of money in detail. Like wherever any gap, as you will see, is more than 1 year, whether it is sale transaction, purchase transaction, employee related cost, financial instrument, revenue recognition, leases, you have to do the discounting. So role of discounting or time value of money has been incorporated to reflect the substance over form. Next feature of IFRS is that more disclosures are required. Okay, and you have to also disclose any assumption that we have used. You have to also disclose any assumption. So let the users also know how the financial statements were prepared, what assumptions were made, okay, what management is thinking. It requires more judgment and estimates also. IFRS requires more judgment and estimate compared to your accounting standards. So few more words on fair value accounting. Is it right? Ind AS and IFRS has given lot of importance to fair value accounting. The purpose is that the financial statement should reflect the economic reality rather than just the historical values. The purpose of financial statement is to help users to evaluate the value of a company and arrive at a more appropriate decision, and that purpose is served if the assets and liabilities of the balance sheet are disclosed at their fair value rather than historical values. Fair values are market driven and are not affected by factors specific to a particular entity, right? So advantage of fair value is that it is a market driven value, how the market looks at the value of that asset and liabilities. Then we will discuss 2 lines about US GAAP also, which is not in our current syllabus. US GAAP is also an internationally recognized standard, but few countries follow US GAAP. Okay, because it is rule based. There are rules for everything or almost everything. You don't have too much of judgment left with you. They will say this is the situation, this is the answer for that. US GAAP is very voluminous also. It is more voluminous than what you see as Ind AS or IFRS. Okay, for your general knowledge, I have passed US GAAP exam, that is CPA, Certified Public Accountant of USA. Okay, with more than 90% marks. I don't know exactly now, I forgot, but it was more than 92, 93%. So you can also try afterwards. Last few paragraphs only and then we are done for the day. Impact on Ind AS. Will Ind AS bring any impact in India? Yes. Now more and more companies will be required to prepare CFS. Earlier few companies were preparing CFS unless it was a listed companies or unless Companies Act required them. But now more and more companies will have to prepare CFS. Will the bonus to employees change? Yes, because your profit calculated as per Ind AS will be very different from profit calculated under old AS. Lot of provisions have to be made. Lot of fair value accounting is done. So as a result of which either the profit can go up or go down. Like if you have made investment in the share market and you are treating it as a fair value through P&L account instrument. If the fair value goes up, profit goes up, bonus goes up, but if the fair value goes down, losses and your bonus will get affected. So remuneration which are based on profit will get severely affected. Share valuation will get affected because your earnings will affect. Since earnings will get affected, dividend distribution will also get affected. Many companies which were using old softwares, they also have to adopt to Ind AS by changing the software. So ERP system will have to be changed in the organizations. Just like when GST was introduced, many companies had to change their accounting softwares. Similarly, companies which will migrate from AS to Ind AS, they also need to upgrade their accounting software. One of the major impacts will be on calculation of ratios. After Ind AS, lot of ratios will change. Why? Let us see one small example. It is a convertible debenture of 100 rupees. Under the old system, that is AS, this entire 100 will appear as a liability, debt. But if it is a convertible debenture, our Ind AS 32 says some portion of it is equity and some portion of it is debt. So now debt portion 100 rupees maybe become only 90 and I have to shift 10 to equity. Similarly, preference shares which we have been showing under share capital for ages, if it is redeemable, then it will come under debt. So your debt equity ratio will change. Current ratios will change. Okay, all key ratios of performance analysis will change. Role of time value of money has increased. Every time there is a gap of more than 12 months, whether it is asset, liability, employee payment, financial instrument valuation, you need to do the discounting. Fair value approach has to be followed in more and more standard. More disclosures will be needed. Now the balance sheet has become very voluminous. Have you seen the annual reports of companies now? Earlier they used to come in 100 pages, now it comes in 300 pages. Why the number of pages have gone up suddenly from 100 to 300? Because the number of disclosures, the detailing that they do is as if the investor is sitting inside the company's finance department and understanding that much level of detailing they are doing. It will have other taxation issues also, because your MAT calculation, which is based on book profit, may change. Your tedious calculations may change because of provision requirement, etc. And now, question which comes to your mind, if there is a conflict between law and Ind AS, law of the land says do this, Ind AS says no, do this, which one will, which one the entity follows? Law will override Ind AS. Law will override Ind AS means if there is a conflict, then provision of the law will prevail. Provision of the law will prevail. Okay. And the financial statement will be prepared in conformity with such law. Law is supreme. Okay. The summary of this paragraph is law is supreme. In India, law is supreme. So therefore, if there is any conflict, law will prevail. And now, one last paragraph for today is name of the standards. So just a quick look at the standards name. Ind AS 1, presentation of financial statement. Ind AS 2, inventories. Ind AS 7, statement of cash flows. Ind AS 8, accounting policies, changes in accounting estimates and error. Ind AS 10, events after the reporting period. Ind AS 12, income tax. Ind AS 16, property, plant and equipment. Ind AS 19, employee benefit. Ind AS 20, accounting for government grant and disclosure of government assistance. Ind AS 21, effect of changes in the foreign exchange rates. Ind AS 23, borrowing cost. Ind AS 24, related party disclosure. Now there is a point. There is an IAS 26 called Accounting and Reporting by Retirement Benefit Plans. Right now in India we have no such corresponding standard for retirement benefit plans. Then Ind AS 27, separate financial statement. Ind AS 28, investment in associates and joint venture. Ind AS 29, financial reporting in hyperinflationary economies. Right now not applicable. Right, not applicable to any companies or even to you also in your syllabus. Then we have Ind AS 32, financial instrument presentation. Ind AS 33, earning per share. Ind AS 34, interim financial reporting. Ind AS 36, impairment of asset. Ind AS 37, provision, contingent liability and contingent asset. Ind AS 38, intangible asset. Ind AS 40, investment property. Ind AS 41, agriculture. Wait, after that there will be a sudden gap and you will wonder what happened to Ind AS 42 to Ind AS 100 gap. There is nothing, because then IFRS 1 was issued. After IAS 41, IFRS 1 was issued. So what we have done, we have added 100 to this number. So if it is IFRS 1, our number will be 101. Okay, our number will match with IAS and our number will be 100 plus IFRS number in case of Ind AS. Name is same. First time adoption of Ind AS. Ind AS 2, share based payment. Ind AS 103, business combination. Ind AS 105, non-current asset held for sale and discontinued operations. Ind AS 106, not in your syllabus, tick mark. Exploration for and evaluation of mineral resources. So whichever are not applicable, tick mark. Ind AS 107, financial instrument disclosure. Ind AS 108, operating segment. Ind AS 109, financial instrument. Ind AS 110, consolidated financial statement. Ind AS 111, joint arrangement. Ind AS 112, disclosure of interest in other entities. Ind AS 113, fair value measurement. One more good news. Ind AS 114, not in your syllabus, regulatory deferral accounts. Ind AS 115 revenue from contract with customer. Ind AS 116 leases. Wait a minute. There is in IFRS 17 insurance contract. This has been issued, but what about us? We are in the draft stage. It is not yet mandatory or applicable right now, and that is why even insurance companies are right now not following the Ind AS. But once this is finalized, approved, issued, then insurance company will also follow Ind AS, because then 117 will be specifically applicable to insurance entities. Is it right? Yes. One more question I want to take, then I will give you off. Question number 7. Whether Ind AS conversion roadmap is also applicable to government companies as defined under section 245 of the Companies Act 2013. Already answered in the notes. It is applicable to all companies which meet either the net worth criteria or listing criteria, not applicable to banking companies and insurance companies for the time being. Okay, so this is the answer. Yes, it is applicable to government company. Ind AS roadmap does not distinguish between government and non-government companies. Question number 8 below, a small question, just 1 minute only. Is net worth for determining applicability of Ind AS is to be calculated as per Indian GAAP or as per Ind AS? Very interesting question. Suppose I want to check my net worth is 250 crore or not. Will that net worth calculation be done as per Indian GAAP, IGAP, or as per Ind AS? Think and answer. Very easy question. Think and answer. The net worth will be calculated as per, very easy answer, as per IGAP or Ind AS? IGAP or Ind AS? The answer is very obvious, IGAP. Why? Our books of accounts are not prepared on the basis of Ind AS only. If you have to calculate, sorry for laughing at your intelligence, if I have to calculate as per Ind AS, first I have to do the accounting as per Ind AS. But I was never following Ind AS. I was always following Indian GAAP till now. And to check whether it is applicable to me or not, I need to first calculate the net worth, not vice versa. That first I apply Ind AS and then check net worth. Then if you are applying Ind AS, why do you need to check applicability? So the answer is IGAP. Indian GAAP, because till now you have been following Indian GAAP. Indian GAAP data is available to you. To get the data under Ind AS, you have to do the whole accounting. Every year you can't do accounting under first Indian GAAP, then under Ind AS to check the applicability. That would be too silly. Okay. So net worth calculated in accordance with Indian GAAP will be used to determine the applicability of Ind AS. So now we'll continue tomorrow. This chapter is over. Thank you very much, everybody.